Hey guys, Jonathan Rose. This video, I'm going to show you how to trade futures. We're specifically going to focus on interest rate futures because the Fed's moving, the yield curve is where the action is, and that's where I think the best trades are presenting right now. So we're going to start at the federalreserve.gov site. After that, we're going to talk about the yield curve a little bit, and at the end, I'll show you an exact trade that I think is presenting a really attractive opportunity for us. So let's get started. So federalreserve.gov. All we're looking at right here is we're looking at the yield on different bonds. And we have the 30-year, 20-year, 10-year, 7, 5, 3, and so forth. Today is December 3rd, so they have the November 29th rates, which you can see all the way over here. Now, if we're going to look at futures contracts, the futures contracts that are traded from the Chicago Mercantile Exchange, we can trade the 2-year, the 5-year, the 10-year, the 30-year, the ultra. But a futures contract, for instance, the 10-year future contract, it's ZN. But that's not really a 10-year bond. What makes up the 10-year future contract is actually a basket of 7 years. Okay? So the 10-year is actually a 7-year. The bond contract, the ZB, it's closer to an 18-year. It's not really 30 years. It's closer to 18 years. The UB is going to be about 30 years. So if we look at the 7-year, the 7-year is trading 1.73%. The 20-year, there's not an 18-year, is trading 2.07, and the 30-year is trading 2.21. So we have 1.73, 2.07, 2.21. Okay? Everyone following along? All I did was take the 10-year yield or the 7-year yield. So all we did, guys, we have the 7-year, which is 1.73%, the 20-year, which is 2.07%, and the 30-year, which is 2.21%. Now, if we look at these like a curve, like a yield curve, we would have the 7-year, it would look like this, 1.73, 2.07, 2.21. And it would look like this, going out higher and higher yield as you have more and more time, right? What's interesting though, and how traders can trade this is you can look at the difference between the instruments. So if this is 7, if this is 20-year, and this is 30-year, well, the difference is going to be, what's this? This is 0.27 plus 7, so it's going to be 0.34, right? 27. And then we could take the difference between the 10-year and the bond contract, and that's going to be 0.14. Okay? Everyone following along? But we can also take the difference between all of these contracts. And the difference between all of the contracts is just going to be 0.34 plus 0.14, which is going to equal 0.48. The reason that I'm showing you this explanation in this format is because it's going to tie in together. And let me show you how it ties in together. If this here is the 10-year future contract, and this is the bond contract, and this is the ultra contract, the difference between the 10-year and the bond contract is going to be 0.34. The difference between the bond contract and the ultra is 0.14. But what I want you to understand is the difference between the ultra bond and the difference between the 10-year contract, 0.48, is made up of the difference between 10s, 30s, and 30s and the bub. So overall, they should kind of move together, right? So let's go to the charts because I want to show you exactly what's happening right now and hopefully this ties the lesson all together. So now I have you on the charts. And on the charts, this chart is going to be the difference between 10s and 30s. It's called the knob, N-O-B. Right here is the difference between 30 and ultra, the ZB and the bub. And over here, it's the entire curve that we've been analyzing, the difference between the 10-year future contract and the ultra future contract. Said another way, we can look at this as the difference between 7-year and 18 years. The difference between 18 years and 30 years. And this is the difference between 7 years all the way out to 30 years. So this plus this equals this. Right now, what's going on is the sum of both parts. The difference between 30 ultra and 7-year, the difference between UB and ZN is rallying like crazy. It's steepening. The difference between ZN and ZB, which is 7 and 18, is steepening like crazy, like it should be doing, right? Boom. But look at ZB UB, the difference between 18 and 30 year, because right now there's a massive, massive disconnect in this part of the yield curve. And the disconnect is presenting a really good trade opportunity because we know this plus this equals this. Well, it's steepening, it's strong. It's steepening, it's strong. This is most likely wrong. So what needs to happen is the bub, ZB, UB, has got to rally, or this thing has got to fall. And if this thing falls, you could sell this, but right now, the actionable trade to consider is going to be getting long ZB and getting short UB. It's a pair trade, a relative value trade, buying one, selling the other. This is how we trade interest rates. This is how I teach to trade all kinds of future contracts. We're trading everything using a relative value approach. My name is Jonathan Rose, and I'm the owner of Masters in Trading. Thanks for watching, guys.